is Bradley Tusk, Tusk Ventures founder and an early investor in Uber. Bradley, good to speak with you. You know, it's always so tough if we're trying to decipher what the market might be saying about those industries, let's say ride hailing, whether it's are people going to go out and be with others and therefore need the ride hailing services? Are they going to stay home and get food delivered? Or it's a labor availability question, too, in terms of them getting drivers. How do you think these companies are situated right now at the kind of cross currents of all that?
It's a great question because they're facing kind of multiple competing challenges at the same time. So the first, obviously, is if the South African variant is as bad as people fear, clearly that could lead to reduced demand for ride sharing going forward, at least for the foreseeable future, if that's the case. I think we really don't know yet, so it's too early to say. The second is regulatory. So yesterday in Brussels, Uber was shut down and barred from operating based on some regulations that to me seem very outdated and unreasonable. But nonetheless, both companies face significant regulatory challenges here in the U.S. and for Uber all over the world. And those are going to continue to put a lot of strain on the business model. And the third is the model itself, right, which is even without a pandemic, even without massive regulatory challenges, it's unclear that ride sharing as a standalone business is a profitable business. Both companies have struggled mightily to make money. They're constantly in wars with each other for customers and for drivers. And I think we have to start thinking about, is there a better business model for ride sharing than the one we have right now?
Well, it's a bit of a, worth going back to the time of the Uber and Lyft IPOs, when even as people tried to project out what the business model would ultimately be, many people said, well, it's kind of just a break even or a push or modestly profitable in the best case scenario until we get to autonomous driving. I mean, are we still in that position of basically hoping that this massive kind of sea change technologically is going to be the thing that rescues the business models?
Yeah, if anything, right? So the original vision for Uber was to be the Amazon of transportation. So anything going from point A to point B, whether it was a giant load of cargo or a human being or a burrito or anything else, was in some way moved by Uber. Now that's limited to just food delivery and ride sharing specifically. Lyft in their S1 when they went public said, we may never be profitable, right? And I know that they were trying to just disclose everything they possibly could, but that might have been a prescient statement, which is the fare that you get from driving someone from point A to point B is only so high. And when you have to split the fare between the ride sharing companies and the driver, oftentimes there's just not enough to go around. And as a result, it's become a deal for drivers that is increasingly difficult to keep taking. And it's become a deal for both companies where, yeah, they may never really show profitability.
I was curious, Bradley, about your take on these stocks that are the poster children of COVID, for better and worse. On a day like today, they worked. Peloton, Zoom Video. Peloton and Zoom Video are 50 to 70% off their recent highs, but are still considered highly valued by the market. So which is it? Are they cheap, or should you have some exposure for days like this when you wonder what's coming next on the COVID front, or stay away?
No, I mean, look, I don't think that they're cheap. I think both stocks were wildly overvalued during the pandemic. We have a tendency as investors, I think probably just as human beings, to look at whatever situation we're in and assume that's how it's always going to be. Right. So, yes, there is a variant in South Africa that looks scary. And yes, that may impact travel companies eventually. But should they be taking the beating that they're taking today? No, I don't think so. Just like, yes, we were in a quarantine, but does that mean that no one's ever going to go to the gym again, or no one's ever going to want to go to a meeting in person again? No, of course not. In fact, if you look at the travel stats for Thanksgiving leading into the holiday, people were really moving around and about quite a bit, almost back to pre-pandemic numbers. So human behavior, people still like to be with other people, still like to go out and do things. It's good to have some hedges like Zoom and Peloton, but to assume that we're heading back into a quarantine to me is unreasonable.
Yeah, clearly one day's action is definitely not enough to sway that argument that we are going back in that direction. Though, the broader weakness recently in things like cloud computing, relatively young companies, the big rush of IPOs in these categories. Fintech is another one that really had been, ran up into the start of the year and then have had a tough go for 10 months now or so. Do you think that that's impacting how private investors are viewing these areas, or slowing or redirecting that kind of venture money, not knowing whether, in fact, the public markets are going to want it?
It should, but it's not. So I am an early stage investor, typically seed and Series A tech companies, and valuations just keep going up and up and up, even when they eventually go public and they have to end up at a decreased valuation simply because the market won't justify those prices and won't keep them at that stock anyway. But whether it's SPACs starting at 10 and falling down to 6 or 7, or just companies getting these really, really big valuations in the private markets, going public and not being able to sustain them, there at the moment is too much money in the venture sector is leading to valuations that are too high and unsustainable, and that's why we have this problem.